Namaskar, hello and welcome friends to Finnovation, your one-stop solution for CFA exams. My name is Shushmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is part of the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
Now friends, we have understood conceptually how this overshooting mechanism happens. That is, first capital inflows happen, then what happens is the opportunities saturate, which actually creates question marks in the minds of the investors, and obviously objectively also the number of opportunities and the return from the opportunities start to saturate in a certain way. And at that time what happens is there are chances of capital outflows. Capital outflows mean reversal of this trend that strengthened the currency in the first place. Now this entire process, specifically the third phase, that is the phase of the capital outflows after the opportunities saturate, is represented by this following equation. So let me discuss this following equation. It's a mathematical expression. Let me discuss it event wise. Let's say in country A, the risk adjusted returns are higher, and in fact the nominal short term rates are also higher. So whether you invest in a bond, whether you invest in a government bond, whether you invest in equity, whether you invest in real estate, all these things are based upon the short term nominal rates that the central banks have decided. And in terms of that central bank short term nominal rates, the rates are different for A and B, and the rate for A is actually higher to begin with than return B. Why that has happened? Because this is in the first place one of the reasons why the capital inflows started. This is in fact one of the reasons because of which the capital inflows started. That is, the capital inflows were attracted by multiple reasons, one being the nominal rates being higher. Now what happened because of high rates is capital inflows happened, then opportunities saturated, and as a result, in the end, capital outflows happened. And this is represented by this entire equation. Now let me go one by one. Now this equation has 5 parts. Let me discuss them one by one. On the left hand side, you have the expected change in the exchange rate of A with respect to B. This is the first left hand side, right? And on the right hand side, you have 5 portions. First is the differential between the nominal short term rates, which is RA minus RB. Then there is a differential between the term premiums between A and B, which is small t A minus small t B. Then there is credit premium difference, that is the differential between the credit premium offered by A with respect to credit premium offered by B, country A and country B, plus equity premium offered by A minus equity premium offered by country B. Then the last portion, which is the liquidity premium offered by country A with respect to country B. Right? These are the 5 portions of the equation. Now initially what happened is the investor finds that the nominal short term rate differential is positive. Maybe the term premium is also positive. Maybe the credit premium is also positive. Maybe the equity premium is also positive. Maybe the liquidity premium is also positive. Or maybe some of them are positive and some of them are negative, but in total the return is positive. So maybe nominal short term rates are positive, then term premium is negative, then credit premium is positive, then equity return premium is negative, then liquidity premium again is positive. In this case, the net effect has to be calculated. If the net effect is positive, then initially investors get capital into this market. They get capital into this market A, right? But as this market gets more and more saturated, then the investors start to think, okay, we are investing here because of higher returns, but are we taking too much risk? Are the opportunities saturating up? That is, if we are not able to capture this differential, capturing this differential means, let's say A and B both have credit risk, right? Now, according to an investor, A is offering credit premium of CA and B is offering credit premium of CB. The investor, let's say, finds that this credit premium of country A is actually more compared to the risk that is being taken, right? So compared to the risk that is being taken in A and in B, CA is more attractive. Credit premium in A is more attractive. So they will put in capital here, right? Everything else being constant, they will put in capital here. Same for the term premium. Let's say the term premium For investor in country A, let's say they find that according to the risk that they are taking, TA is more attractive than TB. That's why capital flows into TA, right? So this is a sort of an arbitrage decision that the investor is taking, that I am taking X amount of risk and I am getting Y amount of return or Y amount of premium. Now, if the risk is comparatively lower, then the investment is logical. But if the risk is much more, especially this can happen when opportunities dry up or saturate, in that case, the investors start to question that, okay, they are offering 8% extra premium, but will I be able to capture it? Is the risk too much that I am taking? If this question has doubtful answers, then capital flight starts to happen. And that's why this excess differential gets cancelled out in the process. So basically what happens is this excess differential, excess premiums that A was offering, as the opportunities saturate, these excess premiums dry up. These excess premiums are cancelled out. Cancelled out how? By adjustment of the exchange rate. By adjustment of the exchange rate. That is, the assets that the country is holding or the assets that this currency is holding, they are considered to be riskier. Although they are offering greater premiums, they are considered to be riskier. As a result, that currency itself weakens. If nothing else is reduced, let's say the government gives higher short-term rates, the companies are offering higher returns, the stock markets are also soaring, maybe they are soaring, the bond markets are also having higher yields, but the investors consider that market A is riskier than it seems. Although they are offering more premiums in all aspects, but it is much more riskier, and we have to reflect it in the form of exchange rates. We have to take out capital, and as a result what happens is, although the assets under currency A portfolio are offering higher premiums, higher returns, but the exchange rate adjusts for this added risk or for this saturation of opportunities, right? And this is given by this expression, that whatever differential you are offering through the higher premiums gets adjusted by downward movement of the exchange rates. Gets adjusted by downward movement of the exchange rates. You may offer higher premiums, but in time they get adjusted through the exchange rates. Right? This is what this equation is saying. And this equation is specifically talking about the third phase. The third phase, when the capital is moving out and the exchange rate is adjusting for the extra premium or the apparent premium that was being shown but was not there in the markets, right? This is what this expression is talking about. So change in the exchange rate or weakening of the currency A with respect to B, according to this equation, is equal to the 5 different premiums offered by the assets under currency A. First is the differential of the short-term nominal rates, RA minus RB. Then is the difference between the term premiums, TA minus TB. Then is the difference between the credit premiums, CA minus CB. Then is the difference between the equity premiums, which is EA minus EB. Then is the difference between the liquidity premiums, which is LA minus LB, right? And all of them can be justified. Let's say one is buying into private equity. And they are measuring the premiums in terms of building blocks. Now first they add the nominal rates, that's fine. Then they add the term premium. Term premium means it can be a 10-year holding period, 5-year, 7-year, 10-year holding period for private equity. Then credit premium. Obviously credit premiums will be there because the assets under private equity can have leverage and the ability to pay back those debt will charge some credit premium, right? Because it's a private equity and that is leveraged, so they have the credit risk which equates to the credit premiums. Then equity premiums, obviously equity premiums also will be there because there is a question of capital gains or capital losses in those investments. And in addition, liquidity premium will also be there because in a private equity investment there is a illiquidity premium. And if opportunities dry up, it will be even harder to sell the assets. So all these things will matter. If you are investing in bonds, maybe the things will end at this level. Short-term nominal rates, term premium and credit premium. It will end here. It will not go beyond that. If you are investing in equity, public equity, then maybe the 4 steps will be required. That is short-term nominal rates plus term premium plus credit premium plus equity premiums. It will end at step 4. If you are investing in direct assets, FDI you are doing, or you are investing in private equity, or you are investing in real estate, let's say directly, then all these 5 premiums might play in. And based on the proportion of assets the currency A has, the exchange rate will adjust accordingly. So this is what this equation represents, and the proportion of different assets that currency A holds matters here very much, because that will decide how much of which of these 5 factors will play out. Uncovered interest rate parity. Now, uncovered interest rate parity claims that of these 5 credit premiums, that is the differential between the short-term nominal rates, the term premium, the credit premium, the equity premium, and the liquidity premium, only the first one matters. That is the differential between short-term nominal rate of A and short-term nominal rate of B. This is what will express as the difference between the exchange rates. Change in the exchange rates. So let's say if currency A has a short-term nominal rate of 8% and currency B has a short-term nominal rate of 4%, then currency A will go down by 8 minus 4 or 4%. This is what uncovered interest rate parity claims. They are claiming that this first factor is the only one that matters. Rest of them can be ignored. Now, in actuality and in the short run, this does not hold. Empirical evidence suggests that this does not hold, and this actually leads to an opportunity which is called the carry trade. So what carry trade means is basically, let's say an investor finds that currency B is offering 4% and currency A is offering 8% on the short-term nominal rates, then the investor can do what? The investor can borrow in currency B at 4% and lend in currency A at 8%. And as a result can capture this differential, because this does not close out in the short run. And in the short run, if this differential persists, then there is a scope of profit making. And that also without investing your own capital. You can just borrow the money at 4%, lend it at 8% and keep the differential, right? And this can happen very often when there is no crisis in the markets. But if crisis ensues in a currency or in a market or in the global markets, then this can go wrong. The investors who look for carry trade are majorly investing in higher riskier assets, right? Assets which are offering higher returns but of higher risk. And during crisis, what happens is there is a flight to quality. So what will happen is there can be capital flights from the higher risk assets to the lower risk, higher quality assets. And this can actually create a very loss-making effect in the carry trades. But apart from that, when the markets are trending, this kind of carry trade is very common because uncovered interest rate parity does not hold during those periods. Hot money flows. So we have been talking about capital flowing in and out, right? So there is too much capital flowing in and there is too much capital flowing out. Both are basically detrimental. And specifically speaking, excess capital flowing in a very short period of time leads to capital flight also. This is the very reason of capital flights. And you can see the Southeast Asian crisis during the 90s was one of the prime examples when this kind of a thing happened. That is, capital inflowed very fast, and then when the opportunity saturated, investors started panicking, and there was a lot of froth in the way leverages were taken up by the banks and financial institutions, and what ensued was a financial crisis and an exchange rate weakening of the currencies of the Southeast Asian region, right? Now here we'll discuss about this phenomenon. It is called hot money flows. Hot money flows, it can be hot money inflows or hot money outflows both, right? And as we have said, hot money inflows generally lead to hot money outflows. And this can be balanced through central bank intervention. One of the ways in which this can be balanced is central bank intervention. First thing is you try to prevent it in the first place through your policies and through your mechanisms. But if it is not possible, if hot money is flowing in the first place, central bank should intervene to balance it out in some way. And if hot money start flowing out, if it is too late, they have flowed in, now they are flowing, it was allowed to flow in and now it is flowing out. Then also central banks should intervene. Then also the central banks can intervene and balance it out. Now how this balancing happens, we will discuss, but before that, we have to understand what are the problems caused by hot money flows. The first problem is, if too much capital is flowing in or out of the currency, then what happens is central banks start finding it difficult to provide a monetary policy which is stable, which is according to the country's interest or the state's interest. So the central bank monetary policy are impacted. This is the first problem. right? The second problem, potential for currency crash and crisis. Firstly, if hot monies are flowing in, that causes overshooting. And when the currency overshoots, there ensues the chance of currency crash. And currency crash means there can be crisis at all levels of the financial segment, which may ultimately lead into non-financial segment crisis also. Potential for currency crash and crisis, right? Because currency first flows in, then overshoot happens, then it starts to flow out, right? The third problem, short-term expenses covered by long-term debt. This happens specifically when hot monies are flowing in. What happens is businesses or financial institutions may start to get loan in a very cheap way or in a very easy way. And what happens then is there is a tendency to cover up short-term expenses by taking long-term debt. And this can be very, very detrimental, because when short-term expenses and short-term earnings are in a cyclical way drying up, then still you have to service your long-term debt. And if they're drying up, the short-term revenues are drying up, the short-term earnings are drying up, then servicing the debt becomes very, very difficult. And this can actually create a crisis. So this is the third problem, short-term expenses covered by long-term debt, which can actually aggravate the possibilities of a crisis or aggravate the intensity of a crisis. Now, hot monies first start flowing in, let's say. What are the steps that the central bank can take? What are the steps that the central bank can take to balance it out? So, we'll discuss this now. Hot monies flow in, right? Hot monies are flowing in because of attractive opportunities, high risk adjusted returns, etc., etc. Now, what happens is the demand for domestic currency goes up. The demand for domestic currency goes up, right? Foreign currency is coming in, getting converted into the domestic currency, and as a result, the domestic currency demand is shooting upwards. Now, this ensues amount of domestic currency reserves are going up. This means that amount of domestic currency reserves are going up, right? Now, here, what happens is the central banks can step in to prevent overshooting. The central banks can step in, and what they can do? They can do three things. First is they can buy out foreign currency. They can buy out foreign currency, and second thing is they can sell out domestic currency. So they buy foreign currency, which is increase a little bit the demand for the foreign currency, which as much as required, then sell the domestic currency as much as required. Now these two things actually soak up the excess liquidity for the domestic currency, right? This soaks up the excess liquidity for the domestic currency, right? But what also happens is the domestic liquidity gets impacted. What happens is because of the selling of this domestic currency, the domestic liquidity has gone up, right? The supply of money goes up. And what ensues is a fall in the interest rates. Interest rates go down, right? And also bank reserves go up. So because there is excess supply, the bank reserves are going up, the interest rates are falling, and the domestic liquidity obviously is going up. So this is basically different sides of the same event. As the liquidity goes up, the supply of money is going up, which means interest rates have to come down for the money to be attractive, right? Because there is more supply, the prices have to come down. You can think it in these terms. There is more supply, the prices have to come down to make it more attractive, and therefore the interest rates come down. And because the supply is going up and it is becoming less attractive, the bank reserves are going up. You can think of it in this way. Now, because of these three situations, one more step the central bank has to take, which is to sell government securities. They can sell government securities to balance this. They can balance the bank reserves, they can balance the interest rates by selling government securities. So these are the steps, series of steps, right? So first the hot money flows in, then demand for domestic currency goes up, the amount of domestic currency in reserves go up, central banks step in, buys the foreign currency and sells the domestic currency. This is to soak up the liquidity. Because of this event, on the other hand, there is something else happening in the domestic liquidity arena where bank reserves are going up and interest rates are going down. To balance this, central banks sell government securities, right? By selling government securities, what happens is the bank reserves can be put in control, and which in turn also puts in control the interest rates. Now what Now what if the hot monies are flowing out? What to do then? Let's discuss. Hot monies are flowing out, right? This is the situation. As a result, what happens is the domestic currency is weakening. Reserves are falling. The reserves are falling for the domestic currency. Also, what is happening is asset prices are falling, there is deflation, and there is a financial crisis, right? All these things might be happening together at different instant. All these things might be happening together in different intensities, right? And as a vicious circle, this also creates more capital flying outwards. More capital flight outwards, right? So this is like a vicious circle which ensues. Here the central bank can step in, and what they can do is they can exactly do the reverse of what they were doing when hot monies were flowing in. During the time when hot monies were flowing in, they were actually selling the domestic currency and buying the foreign currency. Here what they can do is they can buy the domestic currency to increase the liquidity for domestic currency and sell the foreign currency, right? They can buy the domestic currency and sell the foreign currency. Now at the same time, in the domestic arena, certain things are happening. Bank reserves are depleting, domestic liquidity is getting impacted, and the interest rates are going up, right? Interest rates are going up, domestic liquidity is falling, bank reserves are depleting. To balance this, the central bank can buy government securities. The central bank can buy government securities, right? When they buy government securities, bank reserves are restored, domestic liquidity is restored, interest rates are balanced, and they are moderated. Now, when we are talking about assets, we are actually talking about a portfolio of assets. So it can be equity, it can be bonds, it can be real assets, it can be hedge funds, it can be derivatives, it can be private equity, alternate investments, any kind of assets can be there under a single currency. So in the globe, if you see the globe as a portfolio of different currencies together, put together in different proportions, let's say US dollar has certain proportion of different assets, Indian rupees had different proportion of certain assets, some other country has some assets in different proportions demarked or denominated in their currency. That is, when we are talking about American asset portfolio, we are talking about the US dollar asset portfolio, we are talking about under the currency of US dollars, certain amount of assets in certain proportions are denominated by US dollars, certain proportion of certain assets are denominated by Indian rupees, such and such. That's what we are talking about. Now, based on this portfolio proportions, certain dynamics occur, right? Based on this proportion of assets, certain dynamics occur in the global markets. Now, how they play out, let's discuss that. Let's say this is the global market portfolio where there are countries, country A, country B, country C, country D and E, right? Country A, country B, country C, country D and country E, okay? There are 5 countries here. Now, as you can see, these circles denote different size of portfolios. So the global portfolio is denoted by the bigger white circle, right? This is the global portfolio, global market portfolio. This is all the assets that are available globally. Now this is bifurcated into different currencies, and each of these currencies of countries A, B, C, D and E have different proportion of assets. Let's say country A has a certain proportion of equity. Equity is there. Then there is bonds or debt that is there. Real assets are there. Like this, different assets are there, right? Similar for country B, C, D and E. Let's say for country D, they have a different proportion of equity, they have a different proportion for debt and different proportion for real assets, etc. Right? Now, let's say D is an emerging market. D is an emerging market which is expanding. It is a moderate size emerging market which is expanding and expanding in a healthy way, that is in a productive way, right? Now here what happens, we'll see in the next circle. So the initial circle was the smaller inner circle which you can see here, right? The smaller inner circle. This was the initial currency portfolio of currency D or currency of country D, right? Now this expands because of healthy growth or because of growth, this expands. This currency portfolio expands. And because it expands, obviously Investors who are invested in other currencies are getting attracted to it. That's why it is getting expanded, right? Investors who are invested in other currencies are now investing here, right? So here what is happening is a possibility of hot money inflows, right? Obviously this can lead to overshooting, which can in turns lead to hot money outflows, right? Now we have spoken about what the central banks can do to intervene and balance these things out. But there are some self-corrective mechanisms also in the market. There are some self-corrective mechanisms also in the market. What do we mean by that? That is, there are certain ways in which growth can happen, and if those certain ways are followed while growing, then chances of these kind of crisis or these kind of volatilities are reduced or minimized. Now, what are those ways of growth? Let me discuss one by one. The first one is home country bias. If a lot of domestic investors are attracted to this currency, that is, domestic investors of country D are also preferring to invest in country D, then they have home country bias, but it is actually healthy because they are going to balance this hot money inflow and outflow across the cycle, right? Because this is the money which is not part of the hot money inflows or outflows. By hot money inflows or outflows, we are talking about external capital coming in and going out. If the domestic investors are a high proportion of this growth, this investment, then this growth becomes much more robust, much more sustainable. The second point, this is the first point. Let me take the first point. The second point is productivity driven growth. Productivity driven growth. Now, when there is productivity driven growth, this actually attracts investors, both domestic and foreign, and also it is more sustainable. It is more sustainable. Rather than creating asset bubbles or equity bubbles or speculative bubbles, if productivity is driving this growth, then this growth is much more sustainable. This is the second self-mitigating factor or self-correcting factor or balancing factor. The third point is the emerging markets and frontier markets with small initial weights are able to sustain. That is, they are able to sustain much more this kind of growth because of their opportunity base being very large compared to a larger currency portfolio. Let's say compared to USD, another emerging market currency is having a larger scope of investing outside. How? Let me discuss. For example, let's say an investor is invested in assets which is denominated in dollars, right? Now, that same investor is finding an opportunity which is going to give 12% returns annually, but this opportunity is in an emerging market. Now, when this 12% return is being calculated or considered based on the fundamentals of the opportunity, one more thing has to be considered, which is with respect to dollar, how much this currency will hold, how well this emerging market currency will hold. Will it hold? Will it weaken? Will it strengthen? Or whatever is the thing. Now let's say in the last 20 years, this emerging market currency has depleted 5% every year. This emerging market currency has depleted 5% every year with respect to dollars. Now when this investor is considering this 12% return, this investor has to deduct this 5%, that is 12 minus 5 or 7% return they have to consider while making the calculations. Now based on this 7% number, then the investor has to decide whether they are going to invest in this emerging market opportunity or not. So here the investment opportunity is much more difficult. In a way, it is much more difficult. Although the returns are higher, opportunities are there, growth is high, but still in terms of exchange rate specifically or specially, the opportunities become much more riskier or much more volatile. So these things have to be considered. On the other hand, if an emerging market based investor is looking to invest, an emerging market has a lot of scope of growth. First scope of growth is policy changes. Let's say there were capital constraints. They can free up the capital flows. Then let's say there were constraints in nationalization of companies. So many of the industries, let's say, were initially nationalized. They can privatize them, right? That can be the second step. Third step is they can reduce taxes or moderate the taxes, right? Fourth step is, let's say, they can have a lot of headroom for innovation and technological creativity, right? So all these things put together, there are a lot of productive opportunities and real opportunities which are available in emerging markets. On the other hand, if some developed country is looking to grow faster or grow in a way or grow in a way which is equivalent to a frontier market or an emerging market, then they have to really find out such opportunities at a scale which is more often than not that easy to find, right? So this means that if it's a smaller country which is making the healthier changes like productivity growth, like privatization, like innovation, all these things, if that emerging market or the frontier market is doing, if the crime rates are going down, if the policy and the laws are becoming stronger and more robust and more sustainable, then that growth is much more sustainable. So these are a few of the mitigating factors that we had to discuss. Sustainability of large deficits. So friends, there are many countries which as a part of their policy are maintaining deficits, and there are many countries which are maintaining surpluses because of their manufacturing capabilities or manpower capabilities or whatever, right? Now one might think that a sustained deficit of a large amount may not be sustainable, which is very, very true. But there are certain ways in which this deficit can be sustained for a longer period of time. That means there are certain positions or certain criteria, if they are fulfilled, then this kind of a deficit or a large sustained deficit can be maintained and in a healthy way, that is without causing much of a crisis. The first criteria is special status of the currency. The first criteria is the currency has a special status, for example, a reserve currency. If a currency is having a reserve currency status, then the deficit can be more sustainable even if it is large, right? The second thing, the source of the deficit. Now we have seen the current account equation, right? Exports minus imports is equal to savings minus investment plus earnings of the government minus spendings of the government. Now, what is the source of the deficit? This decides if it is sustainable or not. Let's say a country has a deficit due to welfare or excess government spending, right? That is, government spending is higher than the government earnings. Now, this is not sustainable. This is not sustainable. If the deficit is being fueled single-handedly by this is not sustainable. But if the deficit is because of a high proportion of investments which are greater than the savings or the business profits, then it might be sustainable. So this is sustainability of large deficits. Earlier we saw that small deficits for a long time or large deficits for a short time is okay. But both together, that is large deficit for a long time, is not okay. Now we discussed under what criteria a large deficit can be made in a sustainable way, right? Now, when there is a surplus in a country and when there is a deficit in a country, there is a wealth transfer. And the wealth transfer generally happens from the deficit country to the surplus country, right? The wealth transfer generally happens from the deficit country to the surplus country, right? Now, in an assumed perfect scenario where there are no investor biases, that is, all of the investors have identical preferences or utilities, and the degree of segmentation among the nations is almost zero, that is, there is complete global integration almost, there is homogeneous expectations from the markets, and there is perfect capital flow. Under these conditions, there is no impact of this wealth transfer on asset prices. There is no impact of this wealth transfer on asset prices, which means wealth transfer can keep on happening without changing the asset prices. Now, if a market situation, that is the global market portfolio, has happened because of these conditions, that is free cash flows, homogeneous expectations, identical preferences, complete global integration, perfect capital mobility, if a market portfolio situation has happened because of this, so let's say this is the global market and there are different currencies with different portfolios under this condition, right? There is free flow of capital, there is no expectation differences, there is homogeneous expectations, all these things are there. And based on this portfolio differentiation or this portfolio bifurcation has happened. Under this condition, there will be no further change in exchange rate or asset prices. Under this condition, impact on asset prices will be zero or near zero, right? But in a practical situation, there are no free capital flows in a perfect sense. There are no homogeneous expectations in a perfect sense. There is no global integration in a perfect sense. There are no identical preferences or utilities in a perfect sense, right? So we have to think in terms of practical scenarios. In practical scenarios, the major thing that is observed is domestic investors have a home country bias, right? They have a home country bias and they tend to prefer investing in their domestic currency, but they prefer to invest more when it is a surplus domestic currency. When it is a surplus domestic currency, they prefer to invest more in domestic currencies or domestic assets. And they invest less, and they invest comparatively less when it is a deficit currency. When it is a deficit currency, which is their domestic currency, they would prefer to invest less. They may have preferences for domestic currency, but still the investment will be lesser, right? And because of this preference based on surplus or deficit, there will be movements of capital which are going to change asset prices over a period of time between countries to countries, right? Now, investments that are more supportive of the currency. So what is more supportive of the currency? An investment which stays for a longer period of time, does not need to be serviced immediately, is not prone to flight that quickly, right? So what are those kinds of investments? The first is FDI, foreign direct investment is one such investment, right? Let me write the D properly here. FDI, foreign direct investment, is one such investment where it is like a very, very long-term investment that is being made, right? Somebody is building a factory here. Somebody is building a manufacturing base here. Somebody is shifting technology know-hows. Somebody is shifting technology here. So this is a much more long-term, long-viewed kind of currency support, because once this investment gets in, servicing it is a very long-term process, right? They basically want to grow the business here only, in that domestic arena only. Then the next option is private equity. When the investment is something like private equity for example, real assets like real estate or some company which is not in the listed segment, the flight of capital is not that quick or not that easy, because there is a J curve. There is a J curve which may take up to 10 years, 7 years, 10 years or more, right? So the capital stays for a longer while. The servicing is less fast. Then private real estate, as we spoke. Private real estate. This is also quite a long term or a very long term kind of investment. Once foreign direct investment, private equity, private real estate, these kind of investments are made, they are highly supportive of the currency, right? They are highly supportive of the currency. Public equity, on the other hand, is less supportive, because investors can invest for the long term in public equity, but because of the liquidity situation, because the liquidity is very, very high, it can be short term also. So it is less supportive. Less supportive than what? Less supportive than private real estate investment or private equity investment or foreign direct investment. And the last one is debt. Debt is not very supportive of the currency, because it has to be serviced very quickly and it is prone to degrading the currency quality, prone to leading to question marks on the currency and all that. It is not very supportive. In the long run, it is not very supportive. A very high debt to GDP ratio is not a good reflection on the currency, and it can lead to crisis-like situations, right? This should be moderated. The threshold for a developed market might be very high. For an emerging market, it would be lower. For a frontier market, it could be even lower, typically speaking. So debt to GDP ratio is one of the measures of the debt levels that a currency portfolio has, and it is not very supportive at very high levels, right? Specifically, one point needs to be mentioned here. Large and rapid accumulation of short-term debt is a warning sign. Large and rapid accumulation of short-term debt is a warning sign. Okay. Now friends, we have spoken about forecasting equity returns, forecasting bond returns, forecasting real estate returns, forecasting exchange rate movements. Now we'll talk about another asset, which is basically not a direct asset, but it can be traded and it can be speculated upon, and it directly impacts the markets, which is volatility. So we'll try to understand how volatility can be forecasted or expectations can be made on volatility. Forecasting volatility. So friends, when we are trying to forecast volatility, when there is one single asset we are talking about variance, right? And when there is more than one asset, n number of assets, we are talking about variance and covariance, right? And to assess the variance and covariance of a set of assets, let's say n number of assets, what we use is called a VCV or variance covariance matrix. Variance covariance matrix. Now this matrix can be constructed in majorly two different ways. One is the asset based way and second is the factor based way, right? These two are the major ways in which the VCV matrix can be constructed. Now they have their own advantages and disadvantages. We will first talk about the advantages of factor based VCV matrix and then we will move on and talk about the advantages of asset based VCV matrix, right? First, let us talk about the advantages of factor based VCV matrix over the asset based VCV matrix. Let's do it by an example. Let's say there are 4 assets and we are trying to create a VCV matrix, asset based VCV matrix on these 4 assets. These 4 assets, let's say, are A, B, C and D, right? A, B, C and D. Now the matrix will look something like this. So the matrix will look something like this, where all the possible pairs are here mentioned. So A with A first we will do. This will give us the variance of A with respect to A, right? Then we will have A with respect to B, which will give us the covariance of A with respect to B, right? Then covariance of A with respect to C, covariance of A with respect to D. These figures will be there. Then let me change the color of the variance a little bit. Let me give it a color which is lighter green. Okay, so this is the variance. And in the second row, what will happen? In the second row, we will have, in the first box, we will have covariance of A with respect to B, right? Covariance of A with respect to B or B with respect to A, both are the same thing. In the second box, what we'll have? We'll have the variance of B with respect to B, right? In the third box, what we'll have is covariance of B with respect to C, right? Fourth box, covariance of B with respect to D. Now the third row. In the third row, first box will have covariance of A with respect to C. Then we'll have covariance of C with respect to B. C with respect to B or B with respect to C, whichever way you write it is the same thing. Then you will have variance of C with respect to itself. So let me write it double A, double B and double C just to make it seem easier, understandable, more understandable. Now the fourth box will have covariance of C with respect to D, right? What about the fourth row? The first box will have covariance of D with respect to A, or you can write A with respect to D, right? Same thing. Second box, covariance of B with respect to D. Third box, covariance of C with respect to D. Fourth box will have the variance of D. Now friends, a very interesting thing has happened here. If you divide the data into 3 parts, one is the middle triangle from left to right, this one. This is the variance diagonal, right? All the variances are mentioned here. How many variances are there? There are 4 variances, right? And the rest are all covariances. But in the covariances, there are many identical terms. For example, first row, second box, covariance A with respect to B is the same as second row, first box, covariance of A with respect to B. Again, right? In this way, now if you consider that this diagonal elements have divided this box into 2 areas, let me demarcate the box into red colors. The first box goes like this. The first area goes like this. This is the first area. And the second area is here. I'm again marking in red. Please observe. Now these two areas which are marked in red, somewhat like this and this, these two are identical, right? So these are repetitions of each other. So we do not need to count the number of covariances by adding both the boxes, right? Both the box counts. Just one area, if we count the number of boxes, we have the number of covariances. So how many covariances are there? There are 1, 2, 3, 4, 5 and 6. 6 boxes are there with unique covariance values, right? So there are, you can say there are 4 variances, I'm writing once again, and 6 covariances, right? Now if the number of assets is increased, let's say the number of assets n is equal to 100, then how many variances and covariances will there be? Now here the expression comes in. Now this is our asset-based covariance matrix, right? Variance covariance matrix, right? Now here we had only 4 assets. N was equal to 4. Now what if this n is very large? Let's say n is 100. Then how do you do this calculation? How do you do this VCV matrix organization and calculation? How many elements there will be? It will be a very huge number, friends, because the calculation goes like this. For n assets, for an asset-based VCV matrix, the number of unique counts of these variances plus covariances is equal to, there will be n variances and n combination 2 covariances. N combination 2 is basically a permutation combination or a mathematical term. This is measured like n factorial divided by 2 factorial multiplied by n minus 2 factorial, right? Now mathematically this will be equal to, let's not get into the intricacies of it, this will be straight away equal to n into n minus 1 by 2. So which means for 100 assets this will be 100 into 99 by 2. This many covariances will be there. So if you divide it by 2 and 50 cancel out, this becomes 4950. So this is equal to, there will be 4950 covariances and 100 variances, right? This will be the situation when you have an asset-based VCV matrix for 100 assets. So there are huge number of calculations involved here. And if the asset number is 1000, it is even larger. It is much larger than this, right? Now, we need to reduce the noise or simplify it, right? So how do we simplify it? We create something called the factor-based VCV matrix. The factor-based VCV matrix. What do we do? Let's say, again there are n assets, 100 assets, okay? N is equal to 100 once again. So, there is asset 1, there is asset 2, dot, there are 100 assets like this. And for each one of them, what we do is, we create a factor-based return equation. So, return of 1 is given by alpha 1 plus sum of the factors multiplied by their sensitivities beta, right? Sum of the factors multiplied by their sensitivities beta for asset 1, right? So we will not write it like this, we'll write it like this. Beta I1 into Fi1. Now what do I mean by I? So I is basically the number of factors. So let's say there are 3 factors. I is equal to 1 to 3. So this will be a sum of 3 factors. So in case of a factor-based analysis, what you'll do is, you'll create a factor-based matrix which will have 3 factors by 3 factors covariance matrix, as we did in the case of assets also. So it will have 3, beta 1, beta 2 and beta 3 on the columns and rows both, right? So beta 1, beta 2, beta 3 and again beta 1, beta 2, beta 3. So this will have how many unique elements, friends? This will have the variances 1, 2 and 3. These will be the variances and the unique covariances, which is 1, 2 and 3. So there will be total 6 elements here, right? 6 elements. Now if there are k factors, here there are 3 factors. If there are k factors, then how many unique covariances and variances will be there. If there are k factors, there will be k variances plus kc2 covariances, right? K plus kc2. This will be the answer. Now if you simplify it, you would get k plus k into k minus 1 by 2. Now this will be simplified into k into k plus 1 by 2. This many VCV elements will be there. Right? K into k plus 1 by 2 elements will be there in case of a factor-based VCV matrix. But not only this, we need something else. We need all the sensitivities with respect to the 100 assets. So asset 1 has R1 is equal to, or capital R1 as we have written it, is equal to alpha 1 plus beta 1 F1 plus beta 2 F2 plus beta 3 F3 plus the error term, right? Similarly, R2 will have 3 different sensitivities for asset 2, that is beta 1 will be different, beta 2 value will be different, beta 3 value will be different. For asset 3 again the sensitivities for the factors will be different, for asset 4 again the sensitivity factors will be different. So we need 3 into number of assets, that is 100. These many sensitivity values. So if there are k factors and n assets, we need n k sensitivity values, right? So in total what we are left with is, let me write here, in total we have k into k plus 1 by 2 elements. This is for the VCV matrix of factor base, and then we have nk sensitivities. So total these many measurements have to be done. So when there are 100 assets and 3 sensitivities, what you get is 6 plus 300, or 306 different elements to be measured or to be reckoned with. While in case of the asset based matrix, it was 4950 plus 100, which is 5050 elements to be reckoned with. So there is a huge drop in the number of elements that we need to calculate while we are doing a VCV matrix calculation. So here it becomes much more easier, much more simpler. Imagine if there are 1000 assets, how much will be the difference? It will be even more pronounced, right? So this is what the first advantage of factor based model is. The second advantage, let's get into that. So the second advantage is the number of sample observations can often be less than the number of assets that are there in an asset based VCV matrix. So let's say you have 100 assets and the number of sample observations that you have is quarterly for 30 years, which is 90 observations. And the number of observations you have is quarterly for 20 years. So 20 into 4 or 80 observations. So the number of assets is greater than the sample size itself. This kind of situation can give erroneous value of 0 for the risk or the variance, right? This is a big disadvantage when you are dealing with asset based VCV matrix. If you do not have enough number of sample observations, which is very difficult to procure, especially when you are doing calculations of returns and all, because returns you can get quarterly at max, how much more frequent you can get. So if you are not having enough number of observations, it can become very difficult to create a VCV matrix. And if you get enough number of observations, let's say you take quarterly returns for 100 years, another problem that will arise is heteroscedasticity, which means you will combine different regimes to measure out something which is unobservable, right? You want to find out the true value, but for that you are in the situation where you have combined 2 different regimes. For example, the 1970s regime of the interest rates and the 2000 to 2010 regime of the interest rates was completely different. If you combine the regimes, you are actually mixing 2 fundamentally different regimes, right? So this is one more problem of the asset based VCV matrix. On the other hand, if you have like 80 observations and if you have 3 factors, you are quite okay with it, right? Let's say even if you have 5 factors, there are 80 observations, you are still quite okay with this kind of a model because the number of factors is much less than the number of samples that you have. So here you are in a better position. Now the third point is actually a problem for the both. It is not an advantage for factor based, it is a problem for the both, because if you take too much long durations, you are actually risking heteroscedasticity in both the models. So this is a disadvantage for both the models, right? So heteroscedasticity is possible in factor model also, but only if you combine different regimes which are not necessary to be combined while calculating a factor based model. There are certain disadvantages to factor based model also, because you are reducing the number of factors, you are reducing the number of variants to be calculated, but there is a cost to be paid, right? There is a price to be paid for that. We'll look into that just in a while. The fourth point is, this is another advantage for factor based model. For a factor based model, a cross-sectional consistency is much more. Cross-sectional consistency is much more. So for a well-specified model, that is a model in which the factors define the actual realities very well and very completely, then we will have a ratio like this. Before I explain this, let me remove the k here. It would be C. C denotes any constant value. So what do we mean by improves cross-sectional efficiency? Suppose we know that let's say there are three assets I, J and K. Three assets I, J and K who have proportional covariances. That is, covariance of I with respect to J divided by covariance of I with respect to K is a constant, right? Now, we want our measurements, when we create the model, we want our measurements to display this or to demonstrate this as closely as possible, that this value is a constant. But because of model misspecifications, there can be variations. The closest we can get to this is when there is a one factor model, single factor model, and in this kind of a condition, if the specification is very well done, then we can at least reach up to this equation. This equation which I am highlighting, this is covariance of I with respect to J divided by covariance of I with respect to K is equal to sensitivity of J with respect to this one single factor divided by sensitivity of K with respect to this one single factor. This is where we can get up to when there is a well specified single factor model. So this improves cross-sectional consistency, right? Cross-sectional consistency means when we are measuring covariances from asset I to J to K to L, M, etc., right? Cross-sectional consistency. Now, we have spoken about the advantages and also one of the factors, which is heteroscedasticity is possible in both, and there are three other advantages of factor based model that we have spoken about. Now we'll talk about the disadvantages of factor models. So VCV matrix again has two ways to be done. One is the asset based model and one is the factor based model, right? Now we have spoken about the advantages of factor based model. Here we have listed out a couple of disadvantages of factor based model. Firstly, the factor based model reduces the number of variance and covariances, which is very good in its way, but that also creates misspecification of the model. Misspecification of the model, which means the factors that are defining the model are not exactly defining the model the way it should be doing as per the empirical results or as per the real world results. So it is misspecified or biased. And then it is also inconsistent, which means if the sample size is increased, if the sample size keeps on increasing, that the VCV true value will diverge more and more from the sample VCV. So the sample VCV and the true value VCV will keep on diverging as the sample size increases. This means it is inconsistent. Compared to these two factors, asset-based models, asset-based VCV models are unbiased and consistent, right? That is, they are explaining the real world numbers in a much more better way, much more precise way, and they are also not diverging as the sample size increases, right? The true values are not diverging from the sample values as the sample size increases arbitrarily. So these are the main advantages of asset-based VCV matrix. But still, why would we prefer factor-based models? Because we are trying to be more precise and less noisy in our approach. We are choosing something that is not quite exact or not quite correct, but can be measured precisely with less noise compared to something that is much more precise but has much more noise, right? So asset-based matrix has much more noise, so we are avoiding it even though it is unbiased and consistent. we are preferring something that is more biased and more inconsistent because it can be measured with much less noise, is more easier to measure and precise to measure, right? Now, we will talk about something called shrinkage estimate. Now, we have spoken about sample VCV and we have spoken about the target or the true VCV or the known VCV, right? Now, what is the shrinkage estimate? Shrinkage estimate is basically we want to take the best of both. We want to take the best of both. That is, we want the sample VCV also and we want the target or the prior known VCV also, right? We want to combine them. How do we combine them? We combine them with weighted average. This addition is via weighted average or weighed average, right? We'll take an example. So we take a weighted average of the two and that gives us the shrinkage estimate. This will have a higher efficiency. This will have a higher efficiency, which means it will have a lower mean squared error compared to a factor based sample VCV, so as to say, right? Why does this happen? This happens because along with the sample VCV, which has a much lower efficiency, we are adding the target VCV. When we add the target VCV, that is the VCV with the prior knowledge, what happens is we get a higher efficiency. That is, there is a lower mean squared error, right? Now, one example we can take here is estimating volatility from smooth returns. When there is a smooth return, we obviously know that the return numbers are not reflecting the exact market scenarios, right? So, we want to take two kinds of returns. One is the observed return, which is RT minus 1. That is, we are trying to measure a return at time t. We have two aspects. One is the observed return till t minus 1, time t minus 1, that is the previous period. And we have the true return at time t, which is unobservable, right? It is the true return. This one is the observable return. We take a weighted average of the two. We multiply the observed return with a weight called lambda, which is a value between 0 and 1. And we multiply the true return with 1 minus lambda, right? So it is like a decimal value. Lambda is like a decimal value or a weightage or a percentage, you can say. So lambda is between 0 and 1. So this is the way we create this equation. RT is equal to lambda into RT minus 1, capital RT minus 1 plus 1 minus lambda into true return, that is small rt, right? The variance of this kind of a shrinkage estimate is given like this. Variance of the true return r, small r, is equal to 1 plus lambda divided by 1 minus lambda multiplied by variance of the observed return capital R. Observed return capital R, right? So what does this do? This actually increases the variance of the true return with respect to the observed return. For example, if lambda is 0.5, only 0.5 the value of lambda is, then the variance of the true value becomes 3 times the variance of the observed value. How? 1 plus 0.5 divided by 1 minus 0.5. This is equal to 1.5 by 0.5. This is equal to what? This is equal to 3. So variance of the true return becomes equal to 3 times the variance of the observed value, right? This is how this works. Now, where this is applicable? This can be applicable during private real estate purchase, because there you are using something like the REIT index. This can also be applicable during private equity investment, because there the reference is equity index. When the RT, when the observed return is equity index, you are actually trying to invest in private real estate, and you can use this equation, this shrinkage estimate. And in case of private equity, the observed return is taken from the equity index, and from there you adjust it with respect to the true return. You use the lambda value here, and then you decide whether to invest in the private equity investment or not, right? So this is how this kind of equation works. This kind of shrinkage estimation works. Time varying volatility. Time varying volatility. ARC models, that is auto-regressive conditional heteroscedasticity models, right? What do we mean by this? First, let us understand what is volatility clustering. So let's say we are trying to observe the plottings of volatility from 2000 till 2025. So what we may observe is let's say 2 years from 2000 till 2002, there'll be high volatility. There'll be high volatility like this. Then again for a few years, it will be low to moderate volatility. Then again during 2008-2010 period, there'll be high volatilities. Okay. So this is 2000 to 2002 maybe. This is 2008 to 2010 maybe, right? 0 to 010 once again. I'm not being exact, I'm just giving a guesstimate here. So here again you will see low to moderate volatilities again for 3-4 years. Again a little bit higher volatility during 2015-16 when there were some geostrategic changes happening in Europe specifically. Then again in 2020 there will be high volatilities, right? Again a few years low volatility, again maybe recent times a little higher volatility. So this is 2020 and here it is 2025. Now what we are observing is for a period of time, prolonged or an extended period of time, there is continuously moderate to low volatility, and then there are brief periods interspersed between them which have continued higher volatilities. So there is something called clustering of volatilities. Volatility clustering. This phenomenon is called volatility clustering. So is there a way that we can understand the volatility that we are trying to project? Is there a way to measure it? Or is there a way to create an expectation out of it? So what we do is we can create an expectation of volatility by combining the known factors with the unknown factors. How do we do that? We do that like this. Volatility, let's say at time t, the volatility is denoted by variance at time t. This is an expected volatility at future time t, right? Now this is a function of two things. One is the observed volatility at time t minus 1, which is given by variance at t minus 1, and the unobserved factor at time t, which is given by eta square t. So here this equation is showing that variance at time t is equal to a constant given by the value gamma plus alpha into the observed volatility at time t minus 1 plus beta into eta square at time t. So this will be a square here. There will be a square here, right? This is the equation that exhibits it. And we can just modify this equation a little bit. We can do one thing. We can add beta into variance at t minus 1 minus beta into variance at t minus 1. And what we can do is we can rearrange the equation to give us what we have, the second line of equation. This is what we have. Variance at time t is given by gamma plus alpha plus beta into variance at time t minus 1 plus beta into eta square minus variance at t minus 1, right? So eta square is basically the unknown factor, right? This is the unknown factor. And eta square minus variance at t minus 1 is basically the shock at time t. It is the shock at time t, the difference between the unknown factor and what was known already. Because of the unknown factor, something extra happened. So what extra happened, that amount is basically the shock at time t, right? Here a few more factors have to be taken into account. In this equation, alpha plus beta is less than 1. We are trying to follow the rules of a time regression, right? Then alpha, beta and gamma are greater than 0. They are non-negative parameters. Non-negative parameters. What is beta, friends? Beta, subjectively speaking, is the impact of the shock. Beta is the impact of the shock or the sensitivity or the intensity of the shock. Shock is what? The extra amount, that is eta square minus the variance at t minus 1, right? This is the extra amount. Known amount was already the t minus 1 variance. The extra amount is the shock. So beta is basically quantifying the impact of that shock or the sensitivity of that shock on the current variance, right? What is alpha plus beta? Alpha plus beta is the impact of the observed volatility. That is how much the current volatility remembers the previous volatility. How much the current volatility remembers the previous volatility. So the more the alpha plus beta, more the current volatility remembers the previous volatility. That is the volatility at t minus 1. It can be measured and it can be calculated that expected value of the unconditional variance at time t is given by gamma divided by 1 minus beta minus alpha. This can be mathematically deduced. Now we have just overviewed or brushed into a lot of statistics and mathematics here. Much of it, practically speaking, may not be required. I'm just removing the rough work here. Much of it may not be required in practical here, but understanding it helps us a lot. Now we'll delve a little bit into the global portfolio and adjusting the global portfolio as per different factors. Okay. So friends, let's say you are an analyst and you are looking to create for your investors a portfolio taking into account every kind of assets that is available in the entire global markets, right? Now, this will entail a few things. This will entail equities, this will entail bonds, this will entail all other kind of alternate assets, and over and above, this will also entail different currencies in which these assets are denominated in, right? So you have to take into account not only the valuation of the assets, but also how that valuation plays out in tandem with the currency valuation. So there is a duality here, and this combination happens often when somebody is trying to invest internationally into multiple currencies. They are trying to create their portfolios in, right? Now when we are trying to invest in a global way, that is viewing the market as a global market and then zooming in into the assets that we value, and we are also trying to zoom into the currencies that we think are going to do well, then multiple things have to be taken care of, right? What are these factors, and based on these factors, what kind of rebalancings or reallocations need to be done? That is what we are going to discuss now. So making changes in the global portfolio based on macroeconomics. So here the assumption is that the analyst or the asset manager has already created a portfolio based on the global market considerations, and now he or she is trying to make reallocations on that same portfolio based on changes in different national level and global level situations. So national and global, these two factors will be taken into account right now in our discussion mainly. So what are those factors? The first factor is trend growth. So here we are talking about trend growth both in the sense of a country or a state or a currency, and also in the global sense, right? So first let us consider, what if there is change in the trend growth on a country specific or a currency specific way? What to do then? So when there is higher trend growth, it is very good for the equity. Okay, so equity allocation in a country where there is increase in trend growth is a good thing, but it is not such a good thing for the bonds. Because higher trend growth results in higher real interest rates, which in turn reduces the value of the currently yielding or the current interest paying bonds. So this is not such a good thing for the current bonds, right? So there can be reallocation from bond towards equity in markets or in countries or in currencies where the trend growth is rising. And if this rise is due to productivity, then it is even better for equities. If this growth is because of increase in productivity, then it is even better for the equities, right? The third point, higher trend growth without asset price changes can be due to some kind of shock, maybe some new technology. For example, recently there has been multiple breakthroughs at multiple levels in the AI domain. Now what AI is doing is basically it is automating a lot of activities which were previously done manually, and that in effect is basically increasing the productivity without increasing the time required for that increased productivity. And obviously as the employment scenario goes, generally what happens is increase in wages lags behind the increase in productivity. Increase in wages tends to lag behind the increase in productivity. So what happens is, even though productivity increases and the asset prices and the asset values increase, the costs still remain the same. The costs still remain the same. This kind of disruption we are referring to as a new tech shock. So new tech is just a example of a shock. There can be other shocks like policy changes. For example, a country or an emerging market, let's say, had multiple nationalized companies or multiple industries where only nationalized companies were running those industries. Now, due to policy changes, more and more privatization happens. What happens is productivity increases, but because of higher efficiencies, the cost does not increase and in fact it decreases. So that gives an apparent price that even though there is increase in productivity, increase in output, the asset prices are not increasing. We can take an example in India here. In India, let's say coal production is nationalized, right? Coal production is nationalized, and the cost of wages, the cost of equipments, the efficiency of the entire system is in a certain way, right? Now, if there are private players who are brought in, then it is estimated that the entire efficiency can lead to a threefold or a fivefold decrease in cost per unit production of coal. So what will happen is there can be increase in the speed, increase in the quantity of production of coal, but the price of the coal, along with the increase in productivity, the price of the coal can go down. So apparently it might seem that there is some problem, but actually there is no such problem. It's a shock due to increase in efficiency, which has happened due to change in policy. So change in policy, new technology, these are all shocks that come to a market. Higher trend growth without asset price increases or without parallel asset price increases can happen due to shocks. Shocks such as new technology, shocks such as policy changes. Till now, the above 3 points were about country perspective or currency specific perspective. Now we are talking about the global perspective. So if the global trend growth rate changes, what is to be done then? The thing that is to be done then is allocating more to equity than to bond. Allocating more towards equity than towards bond. So if the global portfolio is viewing a change in growth rate or change in trend growth rate in an upward direction, then the allocation should be more in equity and less towards the bond, right? The second point is global integration. So global integration is a very legitimate point specifically for frontier markets and emerging markets. It can be a very valid point for developed markets also, but it is much more valid for emerging markets and frontier markets. Now, emerging markets which are giving higher levels of returns are slowly getting, let's say, more and more integrated with the global economy. Now, this provides an opportunity for investment. How? Because firstly, emerging markets are getting highly integrated with the global markets. This is resulting in reduction in their required return. This is very important, friends. If the required returns change, which means the discounting factor is changing. This means when you calculate the valuation or the present value of an asset with respect to the discount rate, that discount rate itself is going down, which means the present value of investment opportunities is going up. Increase in the value of investment opportunities. This is what is happening in a much more vigorous way in economies which are getting more and more integrated with the global economy, right? Or the global market. So I have just taken an example of emerging markets here. It can be frontier markets also. It can be a few developed markets also. But I'm just taking one example which is very, very valid. The next point is phases of the business cycle. Now in any country, or let's say in a global scenario also, the best time to invest is when? During the trough. That is just after the contraction has ended or around the time when the contraction is happening and recovery is happening. So that is the phase of the trough of the business cycle when investment is best. Let me draw you the business cycle here so that it is better to understand. So early recovery happens from here. Let's say I'm drawing the line here, please follow it. Then early expansion, then late expansion, then slow down, then contraction, and again there is an early recovery beginning here, right? This is how the business cycle looks, right, in time. That's what we have studied here. Now the investment opportunity is during the initial point, that is initial recovery, and also during this trough phase. So it is generally around the trough phase that the best investment opportunities are there, right? During this time, what can be done is bonds, whatever capital were allocated during the contraction in high quality bonds, that can be taken out and put towards the equities. Because the market expansion is going to ensue, and this can lead to higher growth rates, much higher real growth rates, right? Now during the trough, what can be done with the bond portfolio? We have said that the allocation can be done, shifted from bonds to equities. Can the bond portfolio itself be changed? Can the bond portfolio itself also be changed? The answer is yes. The duration can be reduced. Right? How? The intermediate duration portfolios or the intermediate duration bonds in a portfolio can be shifted largely to the short-term bonds. Right? And then a little bit can also be positioned in the long-term bonds. Why? Because rates will change rapidly as the expansion happens, and the older bonds will start becoming less and less valuable. So it is easier to handle a bond portfolio in this kind of a scenario when the duration itself is short. On the other hand, the long-term portfolio is not changed that much. Across the business cycle, the long-term portfolio or the long-term segment of any portfolio of bonds is changed the least, right? It is the short term which changes more vigorously, and the intermediate term which gets impacted in case there is a rapid change in rates. So what this strategy is suggesting is shift from the intermediate largely to the short term, so that the portfolio is more nimble with respect to the changing rates or increasing rates in this case, and also replace the intermediate bonds a little bit with the long-term bonds, so that you also have stability. So there is stability and there is nimbleness or flexibility. That is what is being created here through this portfolio, and this kind of a portfolio is called a barbell portfolio, right? This kind of a portfolio is called a barbell portfolio. Now, these kind of business cycles actually happen in different phases in different markets across the globe, right? One country may be having a peak, the other country may be having the trough, right? The other country which has already had a crash may be experiencing the trough, and some other country may be lagging on the market correction and they may be experiencing the peak. Just an example I am giving here. So it is very important that an analyst or an asset manager understand what phase that specific country or that specific currency or that specific market or state is in before deciding what is going to be the allocation in equities, bonds and other assets. For example, let's say if a currency or a market or a country is in peak condition, then it is better to reduce the equities and increase the bonds. On the other hand, if another market parallelly is in a trough situation, then simultaneously in that market you do exactly the opposite. That is, you increase the equities and you reduce the bond allocations, or create a biased barbell portfolio, as we have said before, right? Now this duration strategy will be reversed when there is a peak, right? This duration reduction happens when there is a trough. This is required when there is a trough. When there is a peak, the reverse should be done. Short term should be minimized and long term should be maximized, right? Now we'll move on to the next point. Now the next point is considering the monetary and fiscal policies of a state or a market. Here, one thing is to be understood is the central bank, or the Federal Reserve for that matter, is generally counter-cyclical, moderately counter-cyclical, because they are trying to counter the momentum in a market so that the cycles are not exaggerated. That is what they are trying to do, right? So the policy rates is the prime tool that they use to do this. The policy rates is the prime thing that they do in a very predictable way or in an expected way, more or less in an expected way, across the phases of the business cycle. So chances are that the more efficient a market is, the better these policies are already priced in into the pricing or the valuation of an assets, right? So making profit or making gains out of speculation on the policy rates can be something less efficient. But what can be something more efficient is the policies regarding structures of the systems of the finance and the monetary policies. What do we mean by that? We mean things like monetary growth. We mean things like quantitative easing. These factors, if the investor analyzes and tries to understand what are the implications in the short term and the long term of these factors, then they can be captured. The possibilities of capturing gains out of these predictions is much more if they are predicted correctly though, right? There are difficulties here because there are two aspects. One is the policy aspect and second is the collective response to the policy. For example, in Japan, negative interest rates were introduced, and because of that, the Japanese policymakers thought that this might create large amounts of investments, large amounts of growth and productivity, etc., etc. But what ensued was a phase where these things did not happen for an extended period of decades, right? From 1990s to, let's say, early 2000s or even early 2010s. This did not happen. So it is very unpredictable how long the response will come once the policy changes have happened. So one has to understand it very minutely and then only bet on it, right? The primary premise of all this analysis is allocating capital where the quality is being maintained, or the striving is to maintain the quality in the long term or the stability in the long term, right? That is the premise of this kind of an analysis. Next point is understanding the current accounts. Now there are nations or currencies or countries where there is sustained deficit. So what is to be done in this respect is those currencies which are experiencing secular or increasing deficit, capital should be reallocated from them towards some other currencies which are experiencing secular or increasing surplus or narrowing deficit. So either the deficit is narrowing or the surplus is increasing or there is a stable or secular surplus, right? That is what is preferred in terms of currency or portfolio allocation. Now, this is about the current account. What about the capital account? The capital account balances actually impact the exchange rates much more in the short run than the current account, right? So here, the primary thing to consider is, has the currency overshot? This is the question. Is there an overshoot already? If there is an overshoot, then reallocate from there to something else, somewhere else. On the contrary, if the analyst feels or the asset manager feels that the currency is undervalued, then combine that undervaluation with the valuation of the assets denominated in that currency or included in that currency, and then invest in good opportunities. That is combining the asset valuation and the currency undervaluation. If some investment turns out to be a good opportunity according to the analyst or the asset manager, then allocate capital there, right? So these are the 6 points on a macroeconomic scale or a global scale or a country specific, currency specific scale that have to be taken into account while doing allocations of capital, right? Now, we have studied all the aspects of capital market expectations in an overview form. We have understood how to create expectation for equities, for bonds, for exchange rates, for volatilities, for macroeconomic scenarios also, and all this combined also, right? Now, it's the time to combine whatever we have learned and try to create a model or a framework through which we create capital market expectations. So let's create that model. Steps to create capital market expectations, right? Now the first step that we do is we choose a certain currency portfolio a certain currency portfolio and select all the assets that are present in that portfolio, right? So there we choose a single currency portfolio, and let's say we choose all the assets that are there in that portfolio. And then what we do is we create a VCV matrix. So here our expectation setting starts. The first step is create a VCV matrix, including all the assets. Now this VCV matrix can be based on assets, can be based on factors, whatever is appropriate. But the first step is create the VCV matrix. The next step is combine Singer-Trehrar model and VCV matrix to estimate equilibrium return for all assets combined. For all assets combined. For all assets, right? So Singer-Trehrar model and VCV matrix, we use both these two things, and then we estimate the equilibrium returns for all the assets. This is our step 2. After this, we move into different asset classes, right? Here in step 2, we were still sticking to all the assets. Now we are going to bifurcate the assets into different asset classes. For example, equity, then bond, and the sub layer behind them, which is the currency. So we'll discuss one by one as you see. So the third step is use Greenwald-Kroner model to assess returns on equity markets. Third step is we talk about equity and we try to create an estimate for equity returns based on Greenwald-Kroner model, right? We know what this includes. This includes the nominal GDP, the dividend yield, the price to earnings ratio, the share purchase. All these formats are there in the Greenwald. All these things are included in the Greenwald-Kroner model. So all these things we use here, right? The next step is we look into the bonds. For bonds, we use the building block approach. This means we use the risk-free rate, then we use the term premium, then the credit premium, then liquidity premium, and combining all this for different tenures, for different maturities, for different credit scenarios, we create expectations for returns on bonds. Now here in this series or in this flow chart, we are only going to talk about equities and bonds. We will not delve into alternate assets as of now. So once we have decided on the equities and bonds, what their expected returns is, we move into the next step, which is forming an opinion on the currency. Whether it has overshot, whether it is undervalued, like that, right? Now we have the valuation of the assets and we also have the valuation of the currency. We can combine these two things to decide whether to invest in equity or invest in bonds or invest in both or invest in neither for a single currency, right? Now we are combining equities and bonds, both the opinions on equities and bonds, and we are also combining it with the opinion on currency, right? This combination is happening in the 6th step. Now this thing is basically we are going from top to bottom into the asset classes and then again floating back up and coming with your valuation for a single currency, let's say. Now we have created an opinion which is combined with the currency opinion and the asset class opinion, right? So the asset class combined with the currency opinion gives us to the next step, takes us to the next step. In the next step, what we do? We combine our opinion based on the combination of opinions on the asset classes and the currency, right? We combine this equity plus bond plus currency opinion. We combine all these things together with the equilibrium returns that we measured using the Singer-Trehrar model and the VCV matrix, right? We combine these two things to ultimately come up with our opinion or the expectation of the capital markets. And the framework for this is the Black-Litterman model. Right? This is the framework. So friends, this is about it for setting up capital market expectations. Thank you so much for being with me in this video. See you in the next class.
The link to the full class video is given in the description below. Please check that out. Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, Keep watching Finnovation. See you in the next class.